Bit of that. Okay, so let's just have a look at this. Is this streaming connected okay? It is connected okay. So what's going on here? Right, evening guys. Well, I've got picture. Let me just refresh my feed here to make sure you're actually getting through a picture, because I've got everything set up on my. There we go. Okay, right. Welcome everybody. Thanks for joining this Friday evening, 5 p.m. I know that typically I have like a recorded video, but with this one, because I've got a guest on, an expert on, I thought I'd do this as a live session as well. So if you've probably seen the title and the thumbnail, we're going to be talking about tax on crypto. I know that it is a topic that most people are interested in, especially if you're holding crypto right now. We're going to get into maybe some of the detail. There's been some new guidance from HMRC that came out today that we're going to talk a little bit about today. We'll try and keep it very high level, but try and give you the things that you need to know, especially if you are in that crypto space. But as always, if you do have questions, feel free to pop them into the comment section and we will get round to them specifically as well. But yeah, I've got the great pleasure of introducing and bringing on Chris Etherington onto this live session with me. Chris, thanks for being here. I know that this is the end of the day for you on a Friday. You could be in a pub somewhere having a beer
Could be.
or doing
I'd
something
rather
very,
be
very
here.
different. Yeah, that's what I like.
No, thanks for having me.
No, no worries, mate. So yeah, obviously we had the conversation on the podcast, which obviously I put the video on here, and I thought it would be great to just make this available as an open conversation for people to kind of, I guess, listen into really around tax on crypto, because you know more than anybody else. Crypto has been a bit of a journey over the last maybe 2 to 3 years, with Bitcoin at an all-time high and doing crazy things, and Ethereum and most of the meme coins as well. But there's always been a little bit of confusion around the tax element to it. So before we get into the questions and stuff, because I do have some questions for you, would you mind just introducing yourself to everyone?
Yep. So good afternoon, everybody. My name's Chris Etherington. I'm a tax partner at an accountancy firm called RSM, which is one of the larger accountancy firms. I mostly work with business owners, entrepreneurs, individuals, their families. I do quite a lot in the tech space. And over the last couple of years or so, I've been doing a lot more in cryptocurrency, both personally and professionally. So yeah, getting my head around what all the tax rules are. And part of the issue is that we don't have any actual specific legislation, no case law. We've got some guidance from HMRC. And so what we're generally doing is trying to overlay rules which apply to things like stocks and shares and other areas and normal financial services, and trying to apply that to crypto. And it doesn't always fit very well, as I'm sure we're going to discuss as we go through this.
Yeah. So within the guidance, then, I mean, guidance is just guidance. I guess it's not going to be very prescriptive. It's open to interpretation. So I guess your expert view of what it means in the context of the tax rules currently. I know you mentioned kind of like yesterday that there's been a whole dump today around new guidance from HMRC in the DeFi space and on staking. I really want to talk about that. So can you just give us a high level kind of like view of what that is? Then we can kind of maybe funnel down a little bit more.
Yeah, so you're right. 2nd of February, they published a whole bunch. I mean, it's quite a lot of guidance, actually, all relating to DeFi. And it's both for individuals and for companies. I've not made my way all through the company part yet. It's sort of quite a lot to get through, but I've digested most of the individual stuff now. And it's focusing on things like liquidity pools and staking in the main, and what they think the tax treatment is of undertaking those transactions. And there are some surprising conclusions that they're coming up with that I think will potentially have fairly, not massive ramifications, but it will impact on the way that people have reported on their tax returns if they've done so. Not everybody necessarily will have needed to do so. But yeah, might end up people having to amend their returns having potentially just submitted them. So yeah, obviously the official deadline for tax returns was 31st of January. It's been a bit of a relaxation this year because of COVID. So people could submit them late in February, but not get a late filing penalty. Usually you get a £100 penalty if it's late. But they published this like 2 days after the
2
deadline.
days
So
after.
it's like, well, yeah, exactly. It's not really helpful for those that are trying to do stuff on time.
Yeah.
But, at least we've got it. So it has been promised for a while. We were expecting it towards the back end of last year. And some of the key takeaway is that they're saying that if you are putting coins into a liquidity pool or staking, that's a disposal that needs to be reported on your capital gains tax pages.
Okay.
And that's, I think a lot of people won't have assumed that. They will have thought, okay, it's my coin, I put it in there, I'm getting a return on it, I'm treating the staking return as income. It's a bit like interest, but HMRC don't call it interest because they don't recognise crypto as a currency, so it can't be interest. Is basically how they bash it. So it's what they call miscellaneous income. Yeah, they can't find any other proper box to put it in, so they're just calling it miscellaneous ultimately. So it's taxable as income. But what we're going to have to do now is report every time that you stake. It's going to be a disposal, and then we've got to put that on the capital gains tax pages as well of your tax return. So it hopefully won't have too much of an impact in terms of the tax paid. It's just a lot more administration, and I'm working with people like Coinly and so on to look at their software and the disposals of things on a professional side. I'm not certain that the software or any of the software houses will be doing this right. And picking this up as a transaction. So, it's not, this could be going back years that people have got their returns wrong effectively.
So what does actually, so if it's going to be as a disposal then, so every time you stake is basically disposal. So that needs to be effectively registered, noted on the tax return for capital gains tax specifically.
So what they say is that if I'm entering into liquidity pool, I'm expecting to get my coins back plus a return, and they're saying you're selling the coins at the point that you put it in, and your return is a right to receive the coins back in the future. So if it was just equal, let's say 1 Bitcoin and you're getting 1 Bitcoin back, it'd be nice and straightforward, but you're going to get some income on there as well. So you're going to have, just from an administrative perspective, let's say, you got a 10% return, you got 1.1 Bitcoin back on your original one that you staked. Well, that will be your disposal, but also you're going to have to put the 0.1 as income on your return as well. So that shouldn't be a problem, but it's ultimately more admin. I don't think it's going to make a huge amount of difference in terms of the actual tax paid. It just means that everyone's been reporting their gains and disposals if they've been doing DeFi incorrectly. So what does that mean? It means potentially that HMRC have longer to look into people's returns because there's been errors and mistakes on them in their view. Like we don't have any legislation, so this is just going on how they're interpreting it. But that means that HMRC can probably go outside the normal 12-month window that they have to look into tax returns. So usually when you submit a tax return, you've got 12 months, and HMRC have an inquiry window, so they can open up details into, look into the details of your tax return to establish whether there's any tax unpaid, essentially.
So we spoke about this on the podcast. And because this is interesting. So they've dropped the guidance 2 days after the deadline. And when we spoke on the podcast, you mentioned that they can go back as far as 20 years if they feel as though you've submitted your tax returns wrong and maybe there is something due that you haven't quite accounted for. So with the guidance that's been dropped, will that mean that retrospectively people may have to go back and adjust their tax returns if they've done one?
Yes and no. So I think the 20-year period, that's when you've deliberately not disclosed something. You've got tax to pay, you've not disclosed. If you've made an error or mistake in your return, then they can go back as far as say 6 years. And a failure to disclose disposals, even if it doesn't really impact on the tax, could potentially open up that 6-year window. I need to think about this a bit harder and really get into the detail of what the risks are to people now as a result of this. And I might write a piece about this and for the press and stuff, and see if I can highlight the issue a bit. But I think what it could do is open up that window, because people haven't been necessarily disclosing things in the way HMRC think they should be.
Mm-hmm.
And that opens up an opportunity for HMRC to dig into the detail of those historical returns. If you made, that's what they're after at the end of the day. Is there any additional tax at stake? So if there isn't, well, it wouldn't be necessarily going to be getting that much interest from HMRC. They've got a lot of data at the moment. We're aware that they've been writing to a lot of the big exchanges and getting this data internationally. Tax authorities are sharing information between themselves. So they've got an awful lot of data. They don't yet have the tools to be able to process that. I think they're working on that. But at the point that they are able to process all of that, well, there could be a bit of a reckoning for people. And then they could be saying, well, you've got X amount of tax to pay from years back. And that's why these discovery powers are so important. So, if you have made a mistake, and they can look into it from because of an error or mistake that's been made, well, potentially go back 6 years from the date that you submitted your return, and potentially longer, like you're saying, if it was actually deliberately not disclosed. So it's not good news ultimately. I think for people, if nobody wants to make mistakes on their returns, do they? And nobody particularly wants to be looking over their shoulder at HMRC for a longer period than they necessarily have to. People want to be. We talked about it before. Like if somebody, clients are coming to me, contacts are coming to me, going, well, I've made a decent amount. I want to be able to sleep at night. I want to be able to report the right amount to HMRC. I might want to put it into a house, And if HMRC come knocking on my door 5 years after I've put it into something illiquid, you're going to have a real problem. I can't sell my house at the moment, Wim. I might be able to get some debt against it, but it all depends on your personal circumstances, and they may have changed since then, mightn't they? So, it's as I say, it's not brilliant news. Great that we've got the guidance. I think ultimately it's good to have clarity, and we need that. And there is, I think, what we really need is proper legislation. That's what, if I was to take anything from this new stuff that's been published, is that if I was looking at it in a pure tax technical way, it's right. Yeah, I agree with the analysis. It's not practical, I think, in a lot of the instances. They've got situations like if we were looking at stocks and shares and we're doing something like we're doing with liquidity pools, like we are with staking, where we're effectively lending people stock and shares. Yeah, you do that. Companies do this. There's tax relief for that, specific tax relief. Likewise, if you get bad debts, peer-to-peer lending, there's specific legislation and laws brought in to account for the fact that if you make a loss as a result of peer-to-peer lending, you can claim that back. There isn't anything like that for crypto. And so we've got this situation where it's being treated in a materially more unfair way, if you like, than it is to something that is more comparable in the financial services system. And yes, the guidance, right, as far as I can see in what I've read, I don't disagree with the analysis. I just think ultimately we need someone to, if we're going to get encourage people to stay in the UK, do business in the UK, and make the most of the opportunities that cryptocurrency and blockchain offer us, well, we need some proper law, and guidance is great, but what it illustrates is that there's a chasm of actual rules that need to be put in place to make this easy to do, to make these sort of investments.
I guess that's the difficult part, isn't it? Because we talk about regulation and having a little bit of rules and stuff, and you argue that it defeats the objective, the whole point of crypto, having a regulator there regulating something, then providing rules around this kind of stuff. But I think when you start looking at it from a tax point of view, because the guidance is so open to interpretation, I think you will have instances where people have just interpreted it wrong through no fault of their own, and potentially it kind of leaves them open for HMRC to be like, well, actually, you did this wrong, and we're going to start knocking on the door, asking for
Yeah.
clarification on these matters. So I can see the argument for having being regulated. I'm a big believer that it needs
It's
to
not, I
be.
mean, you're right. Yeah, you're right. A lot of people would maybe disagree with me and say we don't need regulation. That's the whole appeal of the space.
Mm,
That's the point. But for a lot of people who have entered into this space over the last year or two, I think, why are they going into this? Because they think this technology has real value and can massively disrupt the financial sector going forward. The technology sound,
mm,
but it's not going to increase in value unless we get more mass market appeal.
mm,
And we can't do that unless there's more regulation ultimately, because people look at it and they don't understand it. And there's so many stories of it being Wild West and scammers and honeypot contracts and all of this stuff like Squid Game and stuff like that. We see all the headlines, the negative stuff coming out in the press constantly. The financial regulators hammering Binance and so on over the last year. Until it is more mainstream, it's not going to fulfill the hope value that we're all attributing to these coins at the moment. So to some extent we need it, but I'm going to say that I'm a tax advisor working for an accountancy firm. Of course, I'm more risk averse than a
yeah,
lot
yeah,
of other people. I'm probably going to take
yeah,
a more conservative view on things. But logically, to me, it's simple. It seems like if the more we get regulation, the more we'll be able to sort of get rid of those doom mongers and naysayers that this is just a tulip bubble or another internet bubble from the 90s, and actually it will go somewhere, and the value that we're attributing to it actually will transpire, because we'll increase, say, from the 2.1 million people that's estimated to be in the UK to 4 or 10.
yeah,
It'd be
yeah.
much more like, we'll be able to be looking at this in a decade or 2 decades time and go, well, yeah, this is the new reality, as opposed to the hope that we hope it is.
Yeah. Do you think? I mean, because one of the benefits of if it were to be regulated, I'll talk a little bit about into income tax and capital gains tax. I think that's a really big confusion at this point in time. But I think
Mm.
in my head, I'm kind of like the utopia really for this would be to be able to wrap a Bitcoin portfolio or your Bitcoin holdings, or I don't know, a spot price ETF in an ISA here in the UK and keep it all
Yeah,
completely
yeah.
tax free. But the reality is that's not going to happen
Hmm.
unless some kind of regulation comes in order to make that happen. Um,
Exactly.
and I think
Yeah,
that's really important because I think a lot of people would love to be able to hold crypto in a tax efficient wrapper like an ISA, just as you can
yeah,
do with stocks and shares, and have that benefit. I don't know whether HMRC would look onto that favorably because of the gains that people have seen historically on crypto and stuff, but it
yeah.
would be a nice to have, especially when you start looking at what is actually payable, capital gains tax or income tax, because that's all a bit confusing for a lot of people. And I've had a few people ask me, so when you are staking, what is it? Is it capital gains tax or income tax that is actually
Yeah.
due?
Yeah, and if you the difficulty for them if they were to try and read this guidance is that it's both. So
Okay.
it's incredibly difficult to understand unless you are a professional tax advisor, basically. So what they're saying is that you are subject to income tax on it, so you're getting your return. It's not interest. They make that point
Mm.
throughout because it's not a currency, but it's like interest. So it's this miscellaneous income. Yeah, so you've got to put that on your tax return as income. But when you're doing this disposal to the liquidity pool, you're obviously selling coins. You've got to put a
So you,
price on that.
so capital
And what's the
gains
what's
then
the
comes in.
price? Yeah. So then you're saying, what's the price on the coin that I'm getting in return? Well, it's the original coin plus the return, the income that you've had on it. So that using that example we were saying earlier, that I've staked one Bitcoin. I'm getting a 10% return. It's 1.1 when I get it back. So there's two entries that you need to make in your return. One is the 0.1. That's income. Yeah. And then I've got a gain of 0.1 as well. So I'm not getting taxed twice. There were special rules that say if I'm taxed as income, I get the relief against my gain. But that's why they're saying it's taxed twice almost, but you're getting relief for the fact that you've paid income tax on it.
Yeah,
So do you see where I'm coming from in terms of saying
yeah,
it
yeah,
is so unnecessarily complicated. It doesn't need to be this hard. Yes, that's technically how it works. But if we had proper legislation, the sensible thing would be it's just income, and we don't need to have a disposal there to a liquidity pool, because you're just getting back your original coin. That would be the common sense, pragmatic approach. I think the vast majority of people in this space, if they're trying to do the tax return, will have done it that way. But it's not strictly how you're meant to do it. And that's how HMRC goes. So they're just overlaying, making it harder because of the fact we don't have any proper rules in place for it. So, yeah,
That's really, really
not great.
interesting.
Yeah.
It's really, really interesting because I think, especially with the way things are going at the moment in terms of like interest rates, inflation, the energy price caps, people are naturally going to be looking at whatever money they have in an account and be thinking, okay, maybe I need to do something with this. And I know a lot of people who are moving towards staking. I know that, I think it's crypto.com or something like that. They've got 14.8%, up to 14.8%. It's like we're at the highest level of inflation for a very, very long time. I think it's like 30 odd years at 5.4. Right, fair enough. You can get some online regular saver accounts that will pay. I think one of them is paying like 3.04%. There's another one for 2.5% or something like that. But that's not touching this. That's not keeping up with anything. It's not keeping up with inflation, the rate of inflation. It's certainly not going to keep up with the energy price caps that have just been raised. What, £689? So if you've got money in a bank account, it makes sense that you're then looking and thinking, hang on a second, where can I get the best return? And then staking becomes really, really attractive. But it feels as though there's that potential where if people aren't paying attention to the detail, that ultimately you inadvertently do something maybe wrong whilst doing it, because you don't know that you need to register each disposal and then obviously look at the income tax and the capital gain tax side of things.
You can, like exactly like you say, that the appeal to a lot of people is there because of what's going on in the economy. It's a bit like, for those who are old enough, going back to when we had the financial crash, and we had a lot of sort of Icelandic banks and Indian banks offering really attractive rates, didn't we? There was risk associated with it. There's risk of staking. There's a financial decision to be made there in terms of, even if it's in a stable coin. We all know what people have said about Tether and USD coin stuff over the last year. It's not backed one-to-one. There's going to be risk there. Government, policymakers have been saying that, and they've done investigations in the US and all of that stuff. So, putting that to one side, that's more of an investment decision. But yeah, you're right. If you've got to do this with your eyes wide open and understand what the tax implications are of any DeFi project that you go into ultimately, and the difficulty is, this guidance is helpful, but it only really, as far as I can see, covers some of the more basic DeFi projects that you might be getting into. Like ones that have been described where you're almost getting a fixed return. There are a huge variety, and it's such a burgeoning space, isn't it? Over the last year, the amount of people who are throwing money into DeFi projects, I can only see that continuing, really. So we've almost got like a veneer of what the rules as HMRC see them, but we're still left with a load of uncertainty, and it perhaps is an impossible task for HMRC to keep up, to be honest. But there are. As a tax advisor, as a boring accountant, it is my job, if you like, to talk to my clients and pull the reins on them a little bit. And just take a step back. I know it's exciting. I know that you want to move fast because there's huge, potential returns and stuff. And I don't want to stop projects from happening or investments being made. But it's just like, let's see the wood from the trees and make sure that you're not getting yourself into trouble. And we've talked about some of this stuff before. I think for me, one of the biggest risks is around bankruptcy and making sure that you're doing this in the right way. So
you mentioned this. Can you elaborate a little bit on that, actually?
Yeah.
Can you elaborate on that a little bit? Because I think
so
that's one thing that in the DeFi space, especially with the stable coins, it's the security of it.
Yeah. And it perhaps isn't so much of a risk with stable coins unless there was some collapse, but it's probably in other areas. So if you've got we've all seen the volatility over the last couple of weeks. So let's say you'd made a load of income, and you've been generating big returns in a certain DeFi project or a certain chain, and that you've been paid in coins. Yeah, so you've got this income, that triggers the tax at the point you're paid. Yeah, it's that's your income tax liability for the year, and you've crystallised it, and it needs to be reported on your tax return and submitted the following January broadly. So that's one thing. But what happens then if you've just left those coins as they are? If it was Bitcoin, Solana, whatever it might be, if it's fallen significantly, let's say it was in something really like an altcoin that's dropped 90% or something, you've then you've still got a liability to pay. That loss in value cannot be offset ordinarily, or in the vast majority of cases, against the income that you've generated. HMRC think there's such a high threshold for people to be trading. Yeah, usually when people are trading, like ordinary businesses, Joe Bloggs the plumber. If I make a loss in a year, I can usually offset it against any income that I've made. It's not the case with crypto and this investment. You may call yourself a crypto trader, but HMRC don't see it that way. You're not doing enough. You're not actually, are you professional? Have you got qualifications in this space? Are you like a retired stockbroker or something like that and using algorithms and so on? Those are all sort of factors that you might look at. It's like, yeah, they're professional. They're genuinely trading. There's a huge volume of transactions going on. The vast majority of people aren't doing that, and HMRC say in exceptional circumstances you might be trading, but for the vast majority of the time it's going to be treated like capital gains. So if I make a loss, it's a capital loss. If I've made an income, it's an income tax liability. I can't set them off against each other, and therefore when it comes to pay your tax, you're scuppered, and you will end up in a situation potentially that you've got to find that money to pay the tax liability from another source rather than the coins that you've actually received. So that, we've talked about things like some of the DAO projects, which were ridiculous interest rates being touted around towards the back end of last year. And I was sort of wincing at some of the, people promoting this stuff, because it's like, oh my God, it's, 80,000% return APY. Well, that's fantastic.
Yeah.
But that's just a rug pull and it's going to go straight away. We've talked about rug pulls and stuff before, and it's the same issue. If I've triggered an income tax liability at what is alleged to be a really high value, HMRC will take it based on what you could have turned into fiat at that time. And if it then falls off a cliff, well, that's you up the creek without a paddle.
So what happens to people who, because obviously Bitcoin, that's gone really, really well, but obviously it's taken a bit of a tumble now. So I think we saw highs of 6,000 sort of December. We're now, I think last time I checked, we were in like 36,000 or something like that.
Yeah, I think
If
it was
anyone's
around
holding a
37,
loss,
38 today,
yeah. So if anyone's is currently holding a loss or held a loss prior to tax deadline date, how does that actually work? Are they able? They can't offset the losses that they would have had, can they? Or can they?
You can against gains. So if you've been, just normal trading, as I was sort of describing, it's not strictly trading for tax purposes. But if you're just buying and selling and you're trying to make a gain on a coin, you can offset losses against that. It's if you were doing the staking or you've received income from liquidity pools, etc. That's where you can't offset your losses against it. It's a different type of revenue stream. One's an income stream, one's a gain or loss stream. And a lot of people before sort of 5th of April, that's when the tax year ends, should be thinking about, okay, if I'm sitting on some I'm holding the bag, if you like, and there's some fairly big red losses in my portfolio, but I haven't crystallized them because I'm hodling and I'm thinking, well, it's going to come back. It's going to come back. We're all hoping, I guess. There's a few of us at that camp, I imagine. So, you might want to think about actually trying to crystallize that loss prior to the 5th of April.
Okay.
Because you might have made gains already in the bull run in periods of last year and crystallize those. So every time that you swap coin for coin, it's a disposal. So if you've flipped, then basically you will have some tax to pay, or you need to calculate whether there's any tax to pay. And so on one hand, if you've had all those gains and you've crystallized them, but then since then everything's fallen off the cliff and your portfolio is not looking so rosy anymore, well, actually what you could do is say, I'm going to try and crystallize those losses prior to the end of the tax year. And so I can offset that against the gains, and actually I don't have any tax to pay for the particular year. Because the difficulty with losses is that you can't usually carry them back. So what I mean by that is, like, this is the current tax year, yeah? So we're in the 21-22 tax year because it runs to 5th of April 2022.
Yeah.
If I've made gains in that year, they're payable January, 31st of January next year, the tax relating to that. If I've got losses and I haven't crystallised them, and I crystallise them after 6th of April onwards, yeah, that's the 22-23 tax year.
It's a new
So
tax
on
year.
one hand, it's a new tax year. So on one hand, I've got gains in the 21-22 tax year, and I've got losses in the 22-23 tax year. Well, that's not great, because I can't take that loss in the future tax year and take it backwards.
Take it
That's
back.
what I
Yeah.
mean by carry back.
Yeah.
Yeah. So what you should be thinking about is there a way of trying to crystallize that loss in the same tax year? So I can set one off against any gains that I've got in the same period. It's not necessary for everybody. You know, to go back to basics, everybody can make a certain amount of gains each year, and you don't have any tax to pay if this falls below a certain level. So that's at the moment 12,300. Yeah, if you
Which is
have
the capital
gains,
gains allowance.
yeah, that's the capital gains. It's called the annual exemption. Yeah, and that's fine. So most people will fall within that. If you've been successful and you've made gains over and above that, this is relevant to you, particularly if you're sat on, if your portfolio is looking like it's got some losses in there at the moment. I guess the next question, I'm asking the questions for you, sorry, is how do you how do you crystallize that loss? So there are ways and means of doing it. Some people, and I've seen stuff on Reddit platforms and things like that, querying, I can't get actually crystallize this coin yet. I'm not able to sell it for some reason, depending, I guess it's a project specific issues rather than maybe ones that are in an exchange, or maybe you've staked it and actually you don't want to lose the staking return because it's in a pool or whatever, or getting a fixed return, and you will lose that return. You might be reluctant to actually crystallize the loss. So there are there are a couple of things that you can do. It depends on your personal circumstances. Very simply, swapping from one coin to another would trigger a disposal. Yeah.
Okay.
The difficulty is if you then went back and bought the same coin on the same day or within the next 30 days, it doesn't really achieve it. We've got some rules in the UK called bed and breakfasting.
Yeah.
And that's they relate to share disposals. Yeah. So what people have, this problem has been around for a long time, but in relation to stocks and shares as well. Yeah. It's the same issue.
Yeah.
You might have had a crystallized gains on stocks and shares, and actually your portfolio is at a loss, and people are like, okay, I'd quite like to crystallize this, or I'd like to reset my the acquisition cost, if you like, by crystallizing the disposal. Now, anti-avoidance rules exist. That's what I mean by that, is that special rules are introduced into legislation called tax anti-avoidance rules to stop you taking advantage of situations that HMRC don't want you to. So what they say is that if I sell something, a particular coin or share, and then I buy that again shortly afterwards in the sort of 30-day period, it's not really effective, to be really simplistic about it. The rules are quite complex, so I won't go really into the techie detail. But if you were to say, right, I don't need to be in that project anymore, and I'd rather just go into a different project, then that's fine. That's a disposal, and you won't be affected by these rules. So that's one thing. You could just make a decision in terms of your portfolio and go, don't need to be in that. I'll go into, maybe it could be a similar one, and then I'll go back into it at the after I've passed that sort of month period like I'm talking about. Alternatives, I've heard people ask questions like, can I just sell it to my spouse or civil partner? Is that something that I can do, or can I just sell it to a family member? If you're married, if you're a civil partner, it doesn't work. You are treated basically as, effectively it's a transaction that doesn't trigger a gain or a loss. It's just nil.
Which is different to, and that's different to what you would do in the stocks and shares arena, isn't it? Because you can pass some stuff over to spouse if you're married within the tax rules on the stocks and share side. So that's distinctly different in the crypto space.
It's similar. So what you can do is transfer stuff between spouses, but what it won't do is trigger a tax charge. Yeah, it won't
Right.
crystallize
Yeah.
a loss, and that is the same in stocks and shares. Yeah,
Yeah.
so what it means is that it's exempt, so you can swap things around between spouses, and that can be really tax efficient. But in this scenario, we actually want to trigger the tax, don't we? So
Yeah.
we want it to be taxable, and we say, oh, because it's husband and wife or civil partners, it's not taxable. Disposals to parents, they are taxable. Disposals to children are taxable. Now, you might want to think twice about necessarily trying to get your gran involved or whatever,
Yeah.
but it is in theory possible that you could sell your coins, and you don't necessarily need to change your legal ownership. You need to be a bit careful here because it depends on how you're holding your coins. Some exchanges won't like this, and I'm not. Whatever you do with all of this stuff, you need to take your own advice and make sure do your own research. This applies to tax advice. This is guidance only. Don't take this as read as that you should definitely be doing this. But the key thing is, if you've got the concept here of called legal ownership and beneficial ownership, and what that means in plain English is that you might be the owner of something. Yeah. Your name might be on the house. Let's use property as an example. It's quite simple. So your name might be on the deeds at the land registry. Yeah, you're the legal owner. But then you've got something called beneficial ownership, and that means who's the person who really owns it, who benefits from that property. And you could be the legal owner, but you could say to me, right, I'm going to transfer the benefit of this property to you. I want to gift it to you, Chris, but I can't be bothered to go to the land registry and change all that. So we're going to do something called a deed of trust. It's a bit like a nominee agreement. You're going to be holding it, but you're going to hold it for me. And so that is a disposal. If you transfer the beneficial interest of a coin or an asset of any kind, really, to me, and we're not connected, we're not married, it's if the family, generally speaking, spouses, doesn't work, parents, children, friends, cousins, whoever, it does work. So you can transfer it to them, transfer the beneficial ownership, and that would be a disposal. So that's something that people could explore, but could be in breach of what exchange. Like I say, you need to look at how you're holding your coins. You don't want to get into trouble where somebody freezing your assets, do you? Because you breach terms and conditions ultimately. So there's often with this stuff, great, you've got a perfect tax answer if you like, but remember to think about the practicalities as well and the commercials.
Yeah, I read of an instance where someone did actually do exactly just that. They did a beneficial owner transfer into somebody else's name for them to obviously assume, and it was interesting to kind of read that, really, to be fair, and how that actually worked. I've got a question here in the comment section here. It says, "Hope you're doing well." Let me just bring this up actually, because I think this is a common question that I often get. So do you only pay the tax once you sell it? Now, obviously, there's some nuance here because we've talked about disposals, and well, the tax gets triggered at disposal, I think, if you're staking. But if you're holding, what happens there?
Yeah. So if I was to sell something, then the process of selling that coin and swapping it for, let's use Tether as an example. I've got Bitcoin, I swap it for Tether. That is a disposal. That has triggered a transaction that I need to calculate whether I've made a gain or a loss on that. Yeah. And you don't have to pay the tax immediately. What you need to do is figure out how many gains and losses I've made during a full tax year, so from 6th of April to 5th of April. And then once you've figured out how many gains and losses you made over the whole year, that may or may not be taxable because you, as I was describing before, you get a 12,300 annual exemption each year. And just for clarity, we're talking about UK tax, sterling rather than dollars. So you need to sort of convert it back into sterling.
Yeah.
But assuming that your gains are under that amount, there's no tax to pay at all. And you get that per person. So that's another thing that sometimes we're looking at, that beneficial ownership deed that we were talking about before. People often say, I'd like to put some of these disposals into my wife's or my husband's name or my civil partner's name. And that is feasible as well. That's something that you can look at sort of pre-5th of April planning. If you've got lots of gains and they've exceeded about 12,300 allowance for you, you might be able, and you're thinking, well, actually, I've got some further gains that I would like to crystallize. A, you're very lucky in this current market to have those further gains, but B, you can do it by transferring it into, doing this sort of deed of transfer that we're talking about, or simply just open a wallet for them or an exchange account or whatever and transfer it into their ownership. That would work. And then if they dispose of it, even if it's a spouse, there's no tax on the transfer, and then they can use their annual exemption as well. So that it's only if you exceed that annual exemption that you've got anything to worry about. And then the tax isn't payable immediately. You've got, if we're talking about this current tax year, which finishes in April, so 5th of April 22, you have to do a tax return if you've got tax to pay by the 31st of January 23. And that's also the date that you have to pay your tax by. Mm-hmm. So I guess, again, sort of, boring tax advisor telling you to be safe and secure. Make sure that, between the 6th of April and the 31st of January, you've kept that money somewhere safe and that you put that money aside. A lot of my clients will phone me up almost on the 6th of April and go, even though they're like high, I guess into high risk because they're in the crypto world, like they want to pay the tax then. Tell me how much I need to pay. I want to get it off my books.
Yeah,
and I can understand that philosophy because it's it almost burning a hole in your pocket, isn't it? And you're worried about actually, where can I keep it that's safe? And we're in a strange world economically anyway. With markets going down, with stocks and shares are also risky. You were talking about inflation going up earlier. Well, actually, the value of money is actually going down because of that. Deflationary factors. Obviously, that won't impact on your tax liability, but people, we've been, for those that are old enough, we've seen issues with banks in the past, and banks going bust. And actually, if it's a large liability, then do you need to start thinking about, putting that into sterling and maybe splitting it across a few different banks, just so you've got the security that actually I've definitely got it today. You could do your tax return really early. That would be one way of doing it, and paying really early.
That would probably be the dream, to do it early.
Yeah. But like I was saying, I mean, this is the issue, isn't it? We've got all this new guidance and stuff, which was published the day after the deadline for tax returns. So you may be at risk of doing it too early because there might be a further rule change in a few months' time. And you want to do it. Ideally, you want to do your tax return once, one and done, don't you? So it's a difficult thing to balance. What's the best way to do it? I mean, generally speaking, I think it's sensible to calculate your gain, at least what you think your gain will be early in the tax year. Hold that money somewhere safe. There are various bank accounts and so on that you get is 80 a year that is protected in your bank account if the bank fails for some reason. Hopefully most people, this shouldn't happen anyway. So it's like doomsday scenario, isn't it, from an economic perspective? You've got sort of government-backed accounts like national savings. Some people might look at that. One of the challenges that we've been seeing with clients is actually people transferring it out of the exchanges. The difficulties with the banks, So we know the difficulties with funding, and a lot of the banks have, myself included, you do a transfer and actually it doesn't go through because the banks are micromanaging us to an extent and don't think that we're allowed to go spend it on a gambling website, but we can't spend it on
spend it on crypto.
So
there was a story last week, I think, where this guy was saying he's made 4 million quid, and who was he with? I think he was with HSBC. Frozen account will not let him have the cash out because it came from obviously Bitcoin or whatever he was doing in the crypto space. Some people will say,
you're right. I was quoted in that story.
Well, there you go. Because many people will be like, because people will say, conspiracy theory, the banks are obviously trying to cover their backs because of the real world applications within DeFi and what that basically means for the industry. I'm actually quite excited to see how it's going to pan out in that regard. But you hear those kind of stories and it's just like, how? I mean, I don't understand how they actually justify it. But
I mean, I speak to quite a few wealth advisors and investment advisors, not so much banking. But I know that it's incredibly difficult to open company bank accounts. It's getting increasingly difficult for people to transfer funds into exchanges. And the sort of superficial evidence I hear from seeing on forums and stuff is that people have struggled to actually get their money out of their accounts in some instances to pay their tax liabilities by January. It's this sort of computer says no attitude, the FCA, and again, sort of reverting back to the whole regulation stuff. The banks are terrified, and therefore they're putting up the barriers to us doing this stuff. If we had a bit more regulation and it was a bit clearer, then maybe we could have a more pragmatic solution for all of this. And this is one of the, I wrote a piece recently about what are the benefits of having a CBDC, so like a brick coin, so our own stable coin, a genuine state-backed stable coin. And it's been quite an interesting space in the last couple of weeks with that, because Facebook had their DM, which was formerly Libra, and that seems to have been a little bit quietly wound down. There's a little bit of a race for some of the other larger nations to start creating their own currencies. So that could actually provide a real healthy solution for taxpayers, for HMRC to get their money, because at the moment we have practical. The whole point of this stuff is that we're cutting out the central banks and stuff, and they're causing us the problems with this to some extent. But if the banking system isn't helping us, but if the Bank of England did have its own coin, then we'd feel pretty comfortable transferring from our coin into that, holding it in a safe environment until the 31st of January, and HMRC get their money. So they'll be better off for us doing it at the end of the day. So there are advantages, I think, just from a practical perspective for doing it. But it's been a challenge, I think, for a lot of people this last year, from tax, from financial perspective. And I think it is driving crypto businesses outside of the UK as a result, which it's got to be a bad thing ultimately for us in economic terms, isn't it? So.
Yeah. There is a question here from Alison. This is a question. So if staking is a disposable, is tax on the interest/income triggered when the new coins are transferred out of the stake pool?
Yeah. So best way to describe this is probably to put it into context of, if you had money in a bank account and you received interest, then that would be taxable when it's paid. And HMRC, like I said before, they labour the point a bit about it isn't interest. But if you had to make a comparison, that's probably the closest comparison that you could make. And so I think it's a reasonable position to say, right, if you've got the coins, they've been paid to you and it's in your wallet, then that's taxable as income at that point. So it would be the fiat equivalent, sterling equivalent for UK purposes, of the coin at the point it's paid to the individual, if you can access it. Now, I think it depends on, you need to look at the DeFi projects, because sometimes some of them can be quite complicated. They might be paid, but actually you can't access them. So it all comes back to, is it your coin? Can you direct it? Have you actually got the beneficial ownership of it? So put it another way, how do you define when is it paid? I think you've got to look at it project by project sometimes. So that is the plain simple rule, if you like. And I think then you just got to look at what you're involved with and say, it's a bit like, who has ownership of the coin? Is it you? Can you direct the pool and use it for whatever purpose you want, or do they still have control of it? If they still have control, then has it been paid? That's the question.
Interesting. And we were talking about the whole capital gains, the annual exemption, a bit earlier on, which is 12,300. I think people often get confused about whether they have 12,300 for stocks and 12,300 for crypto. And that isn't the case. It's 12,300 altogether. So if you have a stock portfolio that has done very, very well, and you've got your Bitcoin portfolio that's done really, really well, if you bust that 12,300, then you're going to have tax on the difference.
Correct. So you get it. It's for all gains. So like you say, stocks and shares, property, crypto, whatever it is that you could make a potential gain on, that's taxable. annual exemption applies towards that. So yeah, once you've busted it, you need to start thinking about maybe the other things that we're talking about. Am I the right person to be holding these assets? Should we be sharing the wealth amongst the family pool and utilising other people's allowances as well? You've got to be a bit careful with all of this. You can't just transfer it and it's actually still yours. It's got to be a proper gift. And sometimes you might need the help of a lawyer to draft up the relevant legal agreements to do this sort of stuff. It doesn't necessarily need to be overly complex, but if there's a lot of tax at stake, it can be worthwhile.
Absolutely. There is a question here. What percentage of tax does one need to pay? So I guess that will depend on whether it's being taxed as income or capital gains, then, isn't it? Really?
Yeah, it's a good question. Let's try and tackle it from going back to basics with how income is taxed and how capital gains are taxed. Yeah, because we've got lots of different rates. So from an income perspective, you have what's called a personal allowance, and it's just over £12,500. Yeah, you receive income at that level. Below that level, it's all tax-free. Over and above that, up to around 50,000 over that sort of 12.5 allowance, that's called a basic rate band, and that's taxable at 20%. Vast majority of people fall within those bands. Yeah. Over that, you've got a 40% band, and I'm going to park it at sort of 100k because it starts getting quite complicated at that point. So for the purpose of this example, we've got a 0% band effectively if it falls below broadly 12.5 grand, up to 50k, 20%, up to 100k, 40%. That's income. Yeah. So if you're receiving staking income, you would add that income over and above any other income that you'd earned during that year. If you had a salary, if you were self-employed, interest, savings, whatever it might be, dividend income. So that's your income liability. So it's generally speaking for crypto, you'd expect it to be 20, 40%. It's treated as miscellaneous income in the main. Then you've got capital gains tax. Now, capital gains tax also has an allowance, as we've been discussing, this annual exemption. So 12,300. If you haven't used up all of that basic rate band that I was talking about for income tax purposes, you can use it for your capital gains tax as well. And you get a 10% rate. So remember, up to 50 grandish after the 12.5, you've broadly got £37,500, yeah, of your basic rate band. If you haven't used all of it up for income, you can use it up to the extent that you've exceeded your 12,300 annual exemption for capital gains tax purposes, and it's taxed at 10%. If you're a higher rate taxpayer, you've used up all of those allowances, all of that basic rate band, it's 20%. So I would say vast majority of people are probably paying 20% basic rate tax, assuming they've got a salary that takes them over the personal allowance. And if they are paying capital gains tax on any of their gains, it's probably 10%. If you're a high earner, you're looking at probably 40% or 20%.
Yeah.
Hope it's quite a convoluted way of explaining it. It's really, that's the tax system, unfortunately, is why I've got a job.
So what I thought I'd do actually, and maybe you can help me with this, Chris, is just to kind of like draw this out so the people have the visual representation of the personal allowance is there and you've got zero tax at that point, then up to anything above that 20% up until 50 grand, then it's you've got those tiers within that. So if I'm just going to try and draw it out if I can. 1 second, there we go. Let's there you are. Sorry, mate. Don't know what happened there. So what I'm going to do is maybe just try and draw this out.
For a sec.
Yeah. I'm going to try and draw this out very quickly for people so they've got a visual representation for it as well. So bear with me just 1 second and let me know whether I've got any of this wrong, because you are the expert in this field. So essentially, you have the personal allowance, which is 12,500, right? That's 0%. So you don't pay any income tax on the first 12,500 that you earn. Anything over the 12,500, you're paying 20% tax on. Then I think the next stage is 50k, isn't it? Where you go up to 40%, right? Have I done that right?
Yeah. That's broadly it. I mean, the precise numbers are slightly different, But yeah, that round terms, that's what we're talking about.
Yeah. So basically what he's explaining there and what Chris was explaining there was that, you've got to take it into consideration across your entire income. So if you've already used up all of your 12,500 where you're paying zero tax, then you're going to be over the limit where you're going to be paying 20% maybe at some point. Then if you're a high earner, you're potentially going to be paying 40%. So what tax you pay will be dependent on where you are across your entire income, essentially, right?
Spot on.
Yeah. That's just a visual representation, kind of like for anyone who watches that, because I know that when you talk about numbers, it can be like, whoa, hang on a second.
Oh yeah.
And there is a question on here actually on the allowances there. It says, do I need to declare even if the gains are less than 12,500? Example, the gains are like £2,000. So if for capital gains, it's 12,300, isn't it, for capital gains? I think Chris is just frozen there. I'm actually interested to know the answer to this question because I hear different things that you should declare it anyway, and some people say, well, you don't have to worry about actually declaring it at all. So yeah, you're back now.
Yeah.
I think you're back now,
I'm back.
Chris.
I'm back.
Yeah.
Sorry. Hopefully frozen a very attractive pose. But never happens, does it? So yeah, it's vast majority of the time you're fine, I would say. So if I've just made gains of 2,000, then usually you shouldn't have to declare. The reason I'm caveating that is because it really depends on how many trades you've been doing over the year. So the reason, basically, how HMRC apply this is if you're already doing a tax return. So let's say you're self-employed, yeah, and you've been doing a tax return anyway, and you've made a lot of trades during the year. If the number of trades and the sort of the sale proceeds, if you like, if you top them all up and total them, and that exceeds 4 times the annual exemption, which is 12,300, like you were saying. So let's put it really rough numbers, so 49K. Yeah, it's not quite, maths isn't quite right there, but
yeah,
if
49,200.
you've made disposals and
We'll get Chris back in a second. Yeah, so 4 times the annual allowance is like 49,200 or something like that.
correct,
It works out.
that's it. Yeah, so if you've made trades over that and you already do a tax return, that's really important. And you're required to do it. You have to disclose all your gains and all your disposals, even though there's no tax to pay. So that is something that is strictly how HMRC want you to approach it. But ultimately, it's not going to be any more tax to pay. So would HMRC open inquiries as a result of that? It's difficult to say. It's not. There's no tax at stake for them, so it's an administrative issue more than anything else. A bit like going full circle to what we were talking about at the start. We've got all these new rules, and administratively, there may not be much tax to pay, but yeah, we've not been doing the tax returns right. You really want to do your tax return right. So long-winded answer, and maybe that's why you're hearing differing opinions on it, but I'd say majority of people, you're probably fine because majority of people are probably employed and don't need to do tax returns, and therefore you won't have to disclose it as long as it's under 12,300.
Excellent. Yeah, because that has always been a bit of a contention, and I've always been like, well, I'm not really too sure. You get two sides of, well, you should and you shouldn't, and then people say, well, actually they want you to. But I think on the if you're doing consistent trades, that makes sense. But if you're holding, so if you're just buying and holding, then you haven't got any disposals, have you? So you don't necessarily have to declare them in a way. So really, it's easier to manage if you're buying to hold and you're not actively trading these things, which I guess a lot of people tend to do and have done over the last 2 to 3 years because it's been such an attractive pull into crypto.
Yeah, I think that's right. Yeah, like I say, I guess the the thing to think about, if you are not doing many trades and you are sitting on losses, maybe it does make sense to try and crystallize them. So you've got those. You can carry forward your losses to future years. So if you make gains in the future, you can offset them. So that sometimes people might explore that. If you've got gains on other assets or losses on other assets, again, you can offset those against your crypto gains. So in the vast majority of cases, there are some exceptions to that. But again, it's looking at. I think it's the point you were making before about trying to look at everything in the round, a bit holistically. Don't just think of your crypto. Think about any other investments and assets that you've got.
You made a really good point there, and I had something that popped into my head just a second ago, and it's gone now. I'll probably remember it a bit later on. But patrons just said here, I've done about 200 trades in 1 year. Will this
Have that
still
effect on people?
fall under capital gains? So I guess 200 trade, that's quite a lot. I mean, that's a trade almost every other day. I mean, more than every other day.
It is, but it's yeah. But remember, this is a different space to stocks and shares. So the world of stocks and shares, it would be really unusual to do 200 trades a day. It's not that unusual in the cryptocurrency space, and we are seeing the emergence of robo trading in the stocks and share space. We're seeing the emergence of bots that allow you to do sort of algorithmic trades, if you like, in the crypto world. And it's not difficult to set up. There are plenty of platforms out there that allow you to do this, and will tie in with like APIs into your exchanges and stuff. And they will trade and trade and trade. You could quite easily rack up 1,000 trades a week, if not more. So, I think the key thing to know here is that there is no hard and fast rule. HMRC have a set of rules called badges of trade, and it's a number of different sort of factors that they look at, and you have to look at it in the round. And what I mean by that is that they would say, well, look, what experience have you got of trading? What's the volume? What was your intention when you set out to do this? They look at all of these things and try to determine whether you are so professional that actually you should be considered as a trader or not. HMRC's guidance specifically states that they expect the vast majority of people to fall within the capital gains tax regime. But in exceptional circumstances, people might be trading. And logically, that makes sense because just look where we are now. There's a lot of bag holders out there sitting on losses. If everybody could be considered trading at the sort of level that we're talking about here with 200 trades, and that was really the only sort of influence towards it being trading, quite a high volume, then we'd all be able to use those losses against income tax potentially. So if it's trading and it's a loss, in theory you can offset that against other income, like your employment income. Now, HMRC don't want that. Doesn't appeal to them at all. So I think there's quite a high threshold that you need to meet in order to be treated as trading for capital gains tax purposes. But ultimately, you need to look at it case by case and have a look at those rules relating to badges of trade. You can Google that phrase. There are HMRC manuals that are quite easy to access. As manuals go, it's reasonably digestible to the layman. Tax is tricky. It's not straightforward stuff, but they give you sort of indicators of what they're expecting. I do a lot of this analysis for my clients because a lot of them are doing stuff which it puts them into those shades of grey. We have to do an analysis to whether they are trading or whether it's investment, and it's not always straightforward. But like if you take HMRC's guidance at face value, the vast majority of people should be treated as it just being a capital gain and an investment rather than a trader.
The thing that I was going to ask you was, and it came back to me as you were speaking there, you can carry the losses forward. How far is that? Is it 3 or 4 years you can carry it forward?
No, you can carry it forward indefinitely.
Oh, really? Okay. That's interesting.
It shouldn't be restricted. There does seem to be a bit of misinformation about that. I think
Mm.
some people are saying that you can only carry it forward for a period of time. There are some restrictions in certain circumstances, but for the vast majority of people, I'd expect them to be able to carry their losses for a much longer period than 3 or 4 years.
Yeah, that's interesting, and I guess that kind of, you know, highlights why it's really important for people to actually try and seek actual proper advice, so they can have someone look at it properly to know, right, we can carry this forward to offset against any future gains that you have. I guess that's just the beauty of
Mhm.
having it as part of something you can pull out in the tax arena to help you. Well, I guess pay as little tax as possible where appropriate and where it applies.
Yeah, yeah. I mean, you make a good point there, and it's something I should have probably mentioned earlier in relation to disposals to family members. In that, if you create a loss to a connected person, that can be restricted. So, we
Okay.
might need to think a bit harder about. Usually they call it what is called a clogged loss. It's a connected loss. So if you sell to somebody who's connected with you, it might be better. So it might be better to be a friend rather than a connected person. So that can sometimes it basically restrict you from being able to offset the loss against the gain. So because the gain has to be to the same connected person, if you like. So
Yeah, sure.
that I think ultimately, with this stuff, you've got to think about, if I can crystallize that loss, what are the ways and means of doing that? It's probably, if it's a substantial amount, probably taking tax advice and getting an accountant to look at it. This isn't a technical, particularly complex technical area. Most tax advisors, most accountants would be familiar with these sort of connected loss rules and whether the transaction that you're wanting to do would work effectively for what you're trying to achieve. And we've got plenty of time to be able to get that. You've got 2 months or so to be able to plan ahead. Hopefully we won't have that so many losses. Hopefully we'll have a bit of a recovery by then in any case, in terms of the
Yeah,
markets and so on. But it's something I should have flagged earlier in terms of when we were talking about beneficial ownership and transferring it to
yeah,
people.
yeah. There is one question here. I know you mentioned Coinly a little bit earlier on. Do you know the answer to this?
Mhm.
How do you report your self assessment for capital gains with Coinly? Do you know how that works with them?
I do. So basically, how Coinly works is that you have to pay for an annual report, and you do it sort of tax year by tax year. So you pay them a subscription service broadly, and they will they connect with all your various exchanges and wallets and try and pull that data through. According to their software, will calculate the gains for you, and they give you sort of the headline numbers that you can input into your tax return. Now, I'm not sure it gives you everything that you need, but they do provide you with what's called a tax report. A complete tax report is one of the reports that they provide. They can also provide you with a sort of summary of all the gains in sort of a spreadsheet format, if you wanted to do it that way. We were working with Coinly with the reports that they produce, and it gets us, I don't know, a certain percentage there, if you like, but we
Hmm.
then need to review. There are certain things that it will inevitably flag that it can't process. Sometimes it's airdrops and various sources of income. It's not infallible, is what I'm getting at. And so it does quite helpfully point out where usually there are gaps in the reports and so on. But I think a lot of people, it will give you enough to understand whether you're over that annual exemption 12,300 amount or not.
Yeah,
So that it really helpful from that perspective, because the administrative process of trying to do this manually is really hard.
yeah,
But at least then you've got comfort that I know that I'm below or above the annual exemption and how hard I need to think about this stuff.
yeah. So I guess if they've got the report, they still need to submit to HMRC. You can't do it within Coinly. I would imagine you would have to go do it. They'll give you the
No,
report
you
and then you
can't do it
trans.
within Coinly.
Yeah,
Yeah, yeah.
HMRC directly.
So you've got what's called self-assessment online. You can do that yourself. You can submit. You could even attach a Coinly tax report to your self-assessment online if you wanted to, and add it as a PDF. You can engage somebody like myself, like a tax advisor, and they will prepare a tax return for you and work through the Coinly tax report, make sure that it's correct, and include all the relevant disposals on your tax return for you, because we have our own software basically to do
Hmm.
that.
Cool. Yeah, he was saying here that he's 1,500 over the threshold at the moment. So yeah, I'm sure hopefully this has been useful in terms of giving you a little bit of context for it. Look, I know that we've been on it for about an hour and 10 minutes now. We've spoken about quite a lot in the tax space. If people do want to kind of like have a chat with you and ask a few more questions and reach out to you to
Mhm.
perhaps look after their tax side of things, how do people actually contact you? What's the best way of getting to you?
So you can email me, which is chris.etherington@rsmuk.com. That's a nice, easy way to do it. I'm very happy for people to send me a LinkedIn request. So if you, again, just search me on LinkedIn, hopefully you should be able to find me. It's just Chris Etherington on Google, and it should be able to be one of the first results, hopefully. My profile is on our RSM's website as well. There's a contact button on there that you could use. So hopefully that's enough ways and means and methods to get in touch if you would like to.
Did you say the email address is rsm.co.uk at rsm
It's rsmuk.com.
uk uk.com? Okay, I'm literally just going to put that up
Yeah,
here in a moment. So if you do want to have a chat with Chris, that's how you
that's
can
it.
get hold of him right there. So yeah, by all means. But I really appreciate you for doing this because yeah, tax and it's such a great area, and there are so many videos that it's kind of like, well, we don't what what exactly do you need to do, and it feels as though there's still a lot of kind of like gray to a certain extent. But I hope that people who watch
Mm.
this and who watch this on replay will at least have a bit of a clearer idea of what the guidance basically means and things to be thinking about in the meantime.
Yeah, well, thank you very much for having me. It's been a pleasure talking to you, and hope people found it helpful.
Perfect. Cheers. Right. So, Chris, there you go. Thank you very, very much, guys. Thanks so much for joining me this evening as well. I know this is different to my Friday video because yeah, we normally do a recorded video, so on and so forth. But yes, we thought we wanted to do something different because we did this at like 9 o'clock. And by the way, oh, one thing to just note: I posted a poll this week around the live Q and A's on a Sunday. We've been doing them at 9 p.m. because the original feedback was, yeah, kids are in bed. It's a really, really nice time. We're going to be bringing that forward. 48% of people who voted asked for the lives to be at 8 p.m. So the lives are going to be at 8 p.m. every Sunday, not at 9 p.m. So we're going to bring it forward slightly. So when you'll see the schedule for the live on Sunday, it's going to be at 8 p.m. just so that everybody is aware. But guys, thank you so much for joining us. Really, really, really do appreciate it. Whatever you do this evening, have a good evening and have a good weekend as well. And yeah, thanks again, Chris. Really do appreciate it.
Thanks a lot for having me. Have a good weekend all.
Cheers.